Welcome to Global Risk Community Chat. Today, our guest is Rob Carver. I'm very happy to have you here today, Rob. Welcome.
Thank you. Thanks very much for having me on.
Yes, likewise. Before we get into the topic, can you briefly introduce yourself?
Yes. So nowadays, I'm an independent futures trader, and in the past, I was a hedge fund manager and also traded for an investment bank. I also do some teaching at the University of London, and I've written a few books. And I'm currently writing a new book at the moment, so I'm pretty busy.
Yes, sounds like it actually. So let's then quickly jump into the topic. What would you like to share with us today?
Yeah, so the topic I've chosen is quantifying known unknowns. So I guess the first thing to do is to perhaps remind people of this famous speech given by Donald Rumsfeld when he was part of President Bush's cabinet in the Iraq War in the early 2000s, and he gave this speech, and a lot of people laughed at him and said, "Well, this is, you're just stating the obvious." But actually, it's quite deep what he was saying, and he basically said that you can sort of divide knowledge into four categories, effectively. So there's known knowns, so that's things that we know. There are known unknowns, so those are things we don't know, but we know we don't know them, if that makes sense. Then we have unknown knowns, which is things that we don't realize we know, which perhaps is less interesting and useful, because I'm not sure there are many things in that category for most people, so we can just ignore that one. And then there are unknown unknowns, which are the things that we don't know that we know. So I guess if I think about risk and risk management, particularly in financial markets, which is sort of my area of interest and expertise, the unknown unknowns, they're kind of like what people call black swans, right? They're things that are just, we can't even conceive of them happening almost. It's very hard to sort of protect ourselves from them as well. And although we shouldn't ignore them, of course, and we should spend time kind of trying to consider what those black swans might be, which in a way kind of moves them from the unknown to the known unknown column in a sense, because we were kind of, we were sort of saying, well, it is conceivable that this could happen. But I think it's more useful to think a little bit more about the known unknowns.
Yeah.
So
the stage
go on, please.
The stage is yours. Go ahead with some maybe like key things about it, like some aspects of it.
So I'm going to talk about this all in the context of kind of financial risk management, because that's what although people think that trading is mostly about saying or buy or sell and trying to get that decision correct, actually, successful traders, really, they're the ones who are the best at risk management. In this context of financial risk management, what we have to do is say, well, first of all, we're going to try and model the world, right? We're going to try and form a model of what we expect, say on any given day, we're given a portfolio of assets that we currently hold. What do we expect to happen to that portfolio in terms of risk? What's our likely gain or loss on that portfolio today, given the information we have about historic returns? We don't actually know for sure whether we'll make or lose money today. That would be, I guess, a known. But what we're trying to do is actually kind of quantify the expected distribution of those gains and losses, for example. So we might be able to say, well, I might have a 55% chance of making money today, but around, within that 55% chance, I could also lose money. And my expectation is if I do lose money, then there's a 10% chance that my likely loss will be this. There's a 5% chance my likely loss will be that, and so on and so forth. And the point of that exercise, fundamentally, is to make sure that you are comfortable, both from a kind of theoretical point of view, but also from an emotional point of view, with that distribution of losses. So, if you're taking big positions on because you feel convinced that the market's going to move your way and you're going to make big profits, you have to bear in mind that if the flip of the coin goes slightly the wrong way, instead of making a big profit, you can have a big loss. Is that something that's you're comfortable with, and also is it sort of the optimal level of leverage as well to take? So that's kind of the purpose of that exercise. And obviously, if it's not the case that you are comfortable with that level of risk, or it's a long level of risk, then you need to do something about it. And most usually that would involve reducing your positions. So cutting all your positions in half, say. There's a famous quote from a couple of traders who were talking to each other, and one said, "Oh, I'm terrified of my position. What shall I do? I can't sleep." And the other trader says, "Well, sell down to the sleeping point. Reduce your position to the point where you're happy with it." So this is all fairly well known kind of financial risk management, and I'm sure many of the people listening to this will be familiar with these techniques. But the interesting thing comes when we consider the fact that the parameters that go into this risk model, which are, there's basically two main parameters for the simplest kind of risk model. There's the individual volatility of the individual assets, the risk of the individual assets, and there's also how they move together, their correlation. And what happens normally is when people do these risk management exercises, they assume that we know these statistics with certainty, that we actually know for sure what the standard deviation is and what the correlation is. And from that, you can then come up with a single figure, which is your estimate of your risk today. And from that, you can infer, what your likely distribution of losses is. So you've kind of got, you're trying to move everything into the known unknown columns, right? You're saying, well, I don't know whether I'm going to make or lose money tomorrow, but I know I don't. I know that. Okay, it's an unknown. But you think that you know how unknown that number is. You've been able to quantify it. Mm. Now, what people don't appreciate enough is that measuring the statistics, the risk, the standard deviation, the correlation, those estimates themselves actually have uncertainty in them. So there is an unknowingness about them as well. So we can't actually predict for sure what the standard deviation will be tomorrow, what the correlations will be tomorrow. We can look at historic data and we can get reasonably good estimates of where they were in the past, but it won't necessarily be the case that tomorrow or moving into the future that those risk estimates will be stable. So what you can actually do is use some mathematical techniques to actually quantify the degree of unknowability of these risks. So you're not going to know for sure whether you're going to make or lose money tomorrow. You're not going to know for sure whether what the standard deviation is, in other words, exactly what the distribution of likely losses is. But you can get a good estimate for how uncertain you are about the standard deviation, and from that imply how uncertain you are about your distribution of likely losses. So it's still not going to give you the perfect answer, but it helps you have a better understanding of how unknown and how uncertain these things are. Yes. And the kind of key point to make is that the standard deviation, the risk of the individual instruments, is relatively easy to forecast compared to the correlations. Correlations are really what can shift very dramatically and change very dramatically. When people lose money on kind of big leverage trades, it's normally because of correlations.
Yeah. So from what I hear, it's also a big aspect of decision making. So yeah. So we are running a little bit out of time. So I want to finish off with one last question. And that is, if you were to share one takeaway point so that, maybe our audience is trying to implement, what would it be? The first thing they should start with?
Be really careful about correlations. So because they are of the two things you're estimating in your risk model, they are the one that are the most unstable, and the most practical time when this occurs is when you have a set of positions on which you think are hedged. So you've got some long positions, some short positions, and you think they're hedged. You think the risk is relatively low because the correlation between them is relatively high. Sadly, what can happen is that if you then sort of take leverage on to increase your risk because you think it's a fairly safe position to have on, sadly, what can happen is that the correlation changes suddenly. Those two things that were moving together suddenly no longer are, and you've got a big problem on your hands. So be very skeptical of inputs into your risk model, but particularly correlations.
Yep. Sounds good. Thank you so much for sharing that takeaway point too. I believe that's like a very crucial aspect of it all as well. So with that being said, unfortunately, we kind of run out of our time. So I want to thank you so much for joining us today and sharing your insight. It was a pleasure to meet you. And yeah, thank you.
Thanks very much. Thank you.
Thank you. Have a great day.
You too.